Welcome economic students to this video lecture on the balance of payments. What is the balance of payments? In essence, the balance of payments is a statement of all transactions made between one country and the rest of the world over, say, a quarter or a year. The term balance of payments captures the economic importance of this economic principle. Compare the current account from 1980 through 2010 captured by the blue line across time relative to the capital account captured by the red line from 1980 through 2010. Notice any increase in the surplus of the capital account up top must be set off by an equal increase in the deficit of the current account at the bottom. The current account includes a nation's net trade, imports versus exports, its net earnings on cross-border investment, and net transfer payments or aid. The capital account consists of a nation's transactions in financial instruments. This chart captures the essence of the idea that the capital account and current account must balance out. In other words, any increase in the current account deficit must be offset by an equal increase in the current account surplus. This important idea will be explained in more detail throughout this video. The previous slide demonstrated the important economic concept of balance of payments. Any activity in the current account must be offset by equal activity in the capital account. In this example, the current account incurs a $52 billion deficit, which is offset over the same period of time by a $52 billion surplus in the capital account. Notice the capital account is labeled the financial account on this slide. These terms are often used simultaneously. The current account, which includes net exports, trading goods and services with other nations, investment incomes, and transfer payments, incurred a $52 billion deficit over this period. This $52 billion deficit in the current account was offset by a $52 billion surplus in the capital account. The capital account including FDI, foreign direct investment, and portfolio investments, financial assets transferred between nations. Both of these accounts, the current account and the capital account, will be investigated in more detail throughout the video. Let's continue our examination of the balance of payments by taking the time to discuss in detail the aspects of the current account. The current account is made up of three parts. The first part, something students are familiar with, and also the most important component of the current account, net exports. Assume the United States exports $1 trillion worth of goods and services in 2018. Over the same period, the United States imports $1.5 trillion worth of goods and services. In 2018, the United States incurred a trade deficit of $500 billion. This $500 billion would be added to the current account deficit. There are two other parts of the current account: investment income and net transfers. Investment income, factors of production including payments made to foreign investors. The example here simplifies this idea. A Japanese automobile manufacturer such as Subaru, Honda, Toyota earns money by producing cars in the United States. That would be an example of investment income. Last one, net transfers. In essence, this is donations, aids, grants, whether it's private or public. In other words, if the federal government gives out aid to citizens in other countries, or citizens of America send money privately to citizens in the world. These are the three parts of the current account. Balance of trade and international trade was covered in detail on another video. We will quickly review this important idea. If the United States exports $1 trillion worth of goods and services in a given year, at the same time it imports $1 trillion worth of goods and services, the United States would ultimately have a balance of trade. It is more likely imports would exceed exports, or exports would exceed imports. If exports are greater than imports, the United States would incur a trade surplus. Most likely, since 1974, the United States will experience a trade deficit, a trade gap, where exports are less than imports, or imports are greater than exports. This particular chart simply provides an example of common exports of goods for a year 2002. This chart displays information regarding the U.S. balance of trade from 1930 through 2005. Notice the period post-World War II, from 1945 through 1974. It was not uncommon for the United States to experience a trade surplus, and in some years a rather large trade surplus relative to economic output, that is total GDP. So for instance, in the late 40s, the United States ultimately had a trade surplus of better than 4% of GDP. Since the early 70s, the United States continues to import more than it exports. That is to say, it has a trade deficit. Remember, a trade deficit must be financed by either selling off real American assets or by borrowing. This chart provides trade surplus, trade deficit, balance of trade for select countries in 2009. Notice China ranked first in the world with a $296 billion trade surplus. The United States, 190th in the world with a $300 billion trade deficit. Japan, Germany, and Switzerland also enjoyed large trade surpluses. At the same time, France, Italy, and Spain incurred significant trade deficits. It is important for students to understand trade deficit does not necessarily mean bad. At the same time, trade surplus does not necessarily mean good. Remember, balance of trade is largest component of the current account, and any imbalances in trade will be offset in the capital account. Likewise, the fact that the United States incurs a $380 billion trade deficit, means that U.S. citizens enjoy $380 billion worth of consumption beyond our domestic limitations of output. In essence, it allows the U.S. citizen to consume beyond our domestic production possibilities, limitations, and therefore citizens of the U.S. may actually enjoy a higher standard of living by incurring this trade deficit. Finally, if a nation incurs a trade deficit, it does so by borrowing. The other countries around the world, specifically China, Japan, and Germany, who run large trade surpluses with the U.S., allow U.S. citizens to borrow to finance this deficit, principally because they believe that the U.S. is a strong economy and it's a good economic bet they will be paid back. Let's cap our discussion of the current account by analyzing activity in the current account for the United States between 2014 and 2019. Whenever you are presented with any type of chart or graph, be certain you identify what's being measured on both the horizontal and vertical axis. Here the horizontal axis is simple. It's simply the years 2014, 15, 16, 17, 18, and 19 regarding our current account activity. And on the vertical axis, in billions of dollars, deficit or surplus. Identify the zero mark on the vertical axis. In other words, if the United States did not incur a current account deficit or enjoy a current account surplus, the orange line would go straight through the zero level. Notice the orange line denoting the actual current account measurement. So the current account is made up of three components. The first component, net trade. The dark blue representing our net trade in services, and the gray, our net trade in goods. Take notice, the United States actually incurred a trade surplus in services over these 5 years. The dark blue section of the current account is above the zero line. However, those trade surpluses in services were offset by significant trade deficits in goods. The United States in total had a net trade deficit. Two other aspects of the current account. First, primary income. Earlier we called primary income the net earnings on cross-border investments. A U.S. company such as Coca-Cola has a facility operating in, say, Japan or Germany. That facility generates income. That is an inflow for the United States regarding our current account. At the same time, we mentioned the idea of a Japanese automobile manufacturer such as Toyota, Subaru, or Honda have set up shop here in the United States. Those companies generate income for these foreign entities. That's a primary income outflow. So notice that primary income, or net earnings on cross-border investments, was a positive for the U.S. current account between 2014 and 2019 in every year. The final component of the current account, notice the small piece, again, that's financial aid, sometimes called net transfer payments. It's aid given out by the U.S. government and by U.S. citizens to peoples around the world. Finally, look at the orange track of the current account. Notice that the United States continued to incur a current account deficit around $400 billion per year. Also take note that the level of the current account didn't change much over this period. The United States had a slightly larger current account deficit in 2019 than it did in 2014, but not a pronounced increase in the level of the current account deficit. Up to this point in the video lecture on balance of payments, we have concentrated a great deal of our effort discussing the current account. Now we have to examine the other side of the balance of payments, the capital account. Remember, whatever occurs in the current account must be offset by an equal balance in the capital account. So what is the capital account? Capital account consists of a nation's transactions in financial instruments. Remember, economists sometimes call the capital account the financial account. So it measures the purchase and sale of financial assets abroad. Why would either U.S. companies and citizens purchase financial assets? To earn money. Let's talk about a capital inflow. A South Korean company purchases a factory in Ohio. This type of economic activity is referred to as foreign direct investment. When a foreign company buys a business in a different country, in this case when a South Korean company purchases a business in the United States, this is referred to as FDI, foreign direct investment. More will be discussed about FDI at the end of this video when we examine strategies taken by governments to address their balance of payments. So if a foreign company purchases a U.S. business, that is a financial account or capital account inflow. At the same time, Americans buy financial assets abroad. Example, an American buys a Japanese government bond. That is a financial outflow that would add to the deficit of the capital account. So at the end of the measuring period, whether it be the quarter or the year, we simply calculate the net capital flow, which is the difference between foreign purchase of assets and purchase of domestic assets by foreigners. So how many assets do U.S. citizens purchase? How many foreign assets do U.S. citizens purchase relative to how many U.S. assets foreigners purchase? Down bottom you can see this worked out as an inequality. The United States will incur a financial account, capital account surplus if inflows, that is to say, purchases of U.S. domestic assets by foreigners, is greater than outflows, U.S. citizens purchasing foreign assets. And obviously the opposite would be the case. We would incur a financial account deficit if outflows were greater than inflows. Remember on the previous slide we examined the current accounts from 2014 through 2019, and we discovered that the United States ultimately incurred a current account deficit around $400 billion. The level of the current account deficit would be offset by an equal amount of capital account surplus. By definition, the balance of payments must balance. This chart presents balance of payments in the United States from 1960 through 2017. Again, make certain you understand what's being measured on each axis. Again, on the horizontal axis is simply time, 1960 through 2016. On the vertical axis, we're measuring the current account as a percentage of GDP in the red, and the capital account as a percentage of GDP, the black. Look at the relationship between the balance of payments in the 60s. In the 1960s, the United States experienced a current account surplus. The red line representing the current account was above the zero mark as a percentage of GDP throughout the 60s, which meant that by default the United States experiences a capital account deficit. So the current account surplus in the 60s was offset by a capital account deficit in the 60s. Throughout the 70s there was this trade-off between capital account and current account surplus and deficit, and then we see this divergence where the current account turns to deficit in the 80s until 1991, and then the current account turns to significant deficit starting in 1991 through the current period. One interesting observation about the business cycle and the relationship between current account and capital account. During periods when there is significant divergence, when the red and black line separate, the U.S. economy is typically experiencing economic boom. GDP is expanding, the expansionary phase of the business cycle. And during times when the capital account and the current account converge, the United States is experiencing economic bust, aka a recession. This pattern holds true for the recession experienced by the United States in the mid-70s, the 82 recession, the 1991 recession, and is even observable in the convergence of the capital account and current account starting in 2008, which was the period of the financial asset bubble and housing bubble, which caused a global economic downturn. It's interesting to make these observations and how the economic business cycle ultimately impacts the balance of payments. This chart presents the same information in a condensed time period from 1990 through 2015. Notice there wasn't a significant divergence between the capital account in dark blue and the current account in lighter blue between 1990 and 1997. Starting in 1997, we have significant current account deficit offset by substantial capital account surplus to the tune of $9.8 trillion. One question: should governments take measures to address balance of payments? Some countries might find it economically beneficial to encourage exports, perhaps by following a currency manipulation of devaluing its currency relative to other countries' currencies. At the same time, a country may find it economically important to encourage FDI, foreign direct investment, in their domestic economy. There's no correct answer. It's one of the interesting economic debates. In other words, remember, current account deficit does not necessarily mean bad. At the same time, current account surplus necessarily means good. Simply remember that any activity in the current account must be offset by equal activity in the capital account, aka we must always end with a balance of payments. Thank you for watching. See you in future videos.